Hi, Doug Andrew again. In this episode, you're going to learn how to answer the question, what's the difference between fixed universal life, variable universal life, and of course, indexed universal life? Because a lot of people will ask those questions. You need to know how to answer those questions succinctly but clearly. We're going to talk about the history behind variable universal life, which came after the introduction of fixed UL, and then indexed universal life, which started in 1997. And it took a few years to pick up steam by a lot of the insurance companies. And I've seen all of this migration ever since universal life was introduced back in 1980. We're going to talk about market volatility as it relates to VUL, or for that matter, variable whole life, any variable product, variable annuities and so forth. And you're going to understand why I've never owned one and I never will. Even though I had a Series 1 securities license when I started in 1974, my clients were never happier than when I got their money out of the market in 1980 forward and put it into universal life and then later indexed universal life. And you're going to understand in the next few episodes why and how powerful this is, but you've got to be able to explain it in a simple way for your clients. We're going to talk about the purpose of indexed universal life. And when you understand the purpose behind that, you will eliminate the three biggest dangers: taxes, inflation, and market volatility for your clients. When they understand that, you make them immune from those three dangers, which is what causes most people to outlive their money in retirement. So let's start out with how an insurance company affords to pay policyholders interest on their policies. And we're talking right now mostly about universal life. So when universal life first came out in 1980, the insurance companies simply paid the clients on their policies an interest rate based upon the general account portfolio. So that's called the GAP, General Account Portfolio. You're going to learn more about that in the next few episodes, but generally speaking, if I put my money into a life insurance policy, into an insurance company, they might have billions, some have trillions. One company I put my money into manages $3 trillion. I mean, that's as much as the IRS collects in taxes in an entire year, and that's one insurance company. So what do they do with those billions or trillions of dollars? They diversify, but they have to have their money into very conservative investments. They have to have it into places that are liquid in case of a run on the bank. So that they have the ability to liquidate or give people money when things get really bad and people clamor and want their money. They're scared or they're unemployed or there's a pandemic, something's going on. And so they need liquidity, they need safety. And so most legal reserve insurance companies will have their general account portfolio invested into very safe, predictable, stable, fixed rates of return. So what are those types of investments? They would be AAA and AA bonds, let's say. Now, there are some insurance companies that invest some into what were called junk bonds and so forth, but a good insurance company will invest in AAA and AA bonds. They may have, 20, 30, 40, 50% or more of their assets invested in those. Now, some insurance companies like to loan money, and they usually loan their money maybe on mortgages on huge skyscrapers or shopping malls. These are multi-million and billion-dollar loans. And what's unique is the insurance companies don't operate like a normal mortgage company, loaning 80% loan to value. They may only loan 50% loan to value. So that's why if they ever have to foreclose on a skyscraper, let's say, for example, back in the 1980s, I had a universal life insurance policy back then with a company called Kentucky Central Life. And they had to foreclose on a huge skyscraper in San Francisco. And that got out, and the media made a big deal out of it. And they were acting like, you better hurry and get your money out of that insurance company. They financed that skyscraper. Well, there were people who panicked because of the media, and they took their money out. Well, I knew better. I left my money in. I told most of my clients that believed me, and most of them did, hey, no reason to panic. But there was a ton of people that said, oh, I want my money out. Well, they had the liquidity to do that. Well, the insurance company, sure enough, foreclosed on that skyscraper, multi-million-dollar loan. Listen, the skyscraper was worth far more than the loan. They turned around and sold the skyscraper for way more profit, and we had the most profitable year ever. And so the people who hung in there got a great rate of return. They didn't miss a beat. But because of the media, which usually causes the problems, they scared the public, and people were clamoring to get their money out, and they missed out on a great rate of return. I think I got 12.5% interest that year, tax-free on my money when they foreclosed on this skyscraper, because they only loaned about 50% of the value of the skyscraper. So they can liquidate, they can sell it even at a discount and come out smelling like a rose, so to speak. So insurance companies, if they buy stocks, now very few insurance companies buy very many stocks, maybe 10 or 15% of their general account portfolio might be invested in stocks, but they're very conservative, usually blue chip stocks and so forth, because they're not out there into the volatile investments. And so generally speaking, their general account portfolio yield is pretty predictable because these are bonds, these are mortgages that don't turn over every year. These are mortgages that go 15, 20, 30 years and what have you. So what an insurance company does is they report their general account portfolio yield or rate every single year. So what does that mean? It means that on an annual report, if you're in an era where interest rates are gradually climbing, you might see the general account portfolio, billions, trillions of dollars, move up on an insurance company's annual report from 8% to 8.4. Okay, it moves very slowly, maybe not even that much, because these assets do not turn over that fast. Or in an environment where interest rates drop from the 1990s through 2000, 2010, you saw the general account portfolio yields go down to, from 10 and 9 and 8. It took several years before they finally got down around 6 and 5%. It doesn't happen overnight. Now, that's called the general account. That's the general account where they have all their assets invested, yield. GAAP. This is very, very important to understand for the next few episodes. So the GAAP, the general account portfolio yield, is what the insurance company is earning on their investments, where they have their money invested, which is whose money? It's our money that we've put in there. So they have taken our money and invested it in very conservative investments. So far, so good? So let's go back to the beginning of universal life. In 1980, when it first came out, interest rates were high. I mentioned in a previous episode that mortgages on homes were as high as 18 and 21%. Banks were paying on CDs 10%. And so it was a high interest environment. Therefore, most of these insurance companies where I had my money in universal life, their general account portfolio yield from 1980 clear up till 1990 for 10 years was in excess of 10%. I never earned less than 11.75%. I earned as high as 15.5%. So that means that if I just left my money in the insurance policy, the bucket, the compound interest was earning rates in the 11 to 15% range. I didn't have to do anything. That was just there. So if I'm earning, like I've said, 11, let's just take it down to 11, and I structured the policy correctly with the least amount of insurance under TEFRA and DEFRA, I was netting on the average 10%, 1% less than the gross rate of return. And so the insurance company was crediting me that interest. Now, in actuality, the insurance company was maybe earning 12. They need usually at least one of those percentage points for their profit. They don't have this huge profit margin because a lot of times banks and credit unions, they borrow our money and pay us 1% the last decade or two, and they turn around, they make 3, 4, 5%. They have a lot of overhead. Whereas an insurance company, even though they may house a lot of employees in a skyscraper, they're managing in one building full of employees as much money as the IRS collects in income tax in an entire year. I mean, do you know how many employees that is? Hello? And so they're able to operate usually maybe at 1.5%. So they might be earning 12 or 12.5. They're crediting me 11. One of those 11 percentage points pays for the insurance and all the fees and costs, and I'm netting 10%. But the general account portfolio yield might be 11 or 12, something like that. Does that make sense? So that's how the insurance company operates. They're in business to make a profit, but they're making a very small margin, and they're paying me on universal life whatever after their fee, whatever they can, and then the cost of insurance comes out of that. But if you structure it correctly, if they're crediting me 9, I net 8. If they credit me 8, I net 7. If they credit me 11, I net 10 on the average if I've done it right. So that's paid based upon the insurance company's performance, the rate of return, the yield on what? The general account portfolio. That's called the GAAP. This is going to come into play big time when I teach you about indexing. And this is what a lot of insurance agents and the general public doesn't understand. So once you understand the general account portfolio yield, when Universal Life first came out, that's what I was credited, and I never earned less than 11% for the first 10 years. Well, all of a sudden, interest rates started to come down a little bit, and so people said, well, I want to go for it. I want to put my money in the market. And they forget about the crashes. But that's when variable universal life came out. Now, variable universal life basically says this. If you put your money into the insurance policy, the bucket, we need to keep enough in there just to cover the spigot, the actual COI, cost of insurance. But all the rest of the money, the cash value in there, we will send it out into like a mutual fund environment out in the market. Oh, well, that sounds like, wow, I can now make money when the market's doing well. Well, what does it also mean? When the market crashes, you will lose. Now, I've always remembered Warren Buffett's 2 rules of investing. Rule number 1, don't lose money. And rule number 2, don't forget rule number 1. Okay, so variable universal life, I told you here that my clients were never happier. I had 3,000 clients. They were never happier in 1980, 81, 82, and so forth than when I got their money out of the volatile market, ups and downs, and put them over into the fixed portfolio tax-free with the insurance company. But in the 1990s, when the general account portfolio rate started coming down, well, inflation came down too, but people were like, ooh, no, I want to earn 12%. I want to earn 15%. And so the industry came out with variable products. They kept just enough to cover the cost of the insurance, and the rest was invested out in the market. Well, do you know that on the average in a 10-year period, ever since the Great Depression, 7 of the 10 years in any 10-year period, you'll probably have gains up. But the other 3 years, you'll lose. Now, 2000 to 2010, you had 5 down years compared to 5 up years. That was horrible. So when you're in a variable product, it means that if the market drops down 40% like it did twice in that decade, if you had $1 million of cash value in the insurance policy, it would go down to $600,000 twice. Well, if people were minimum funding it or didn't have it maximum funded yet, all of a sudden the insurance company would say, you're not covering the spigot on your bucket. The cost of the insurance now, there's no money there. You've lost so much money by having it in the market. You've got to now hurry and throw some more money in this insurance policy. Well, all of a sudden people thought, well, I didn't know I had to do that. Well, hello. You put it out in the market in a variable environment, and we lost 40%. You've got to hurry and pay a bunch of money into this insurance policy or it's going to lapse. Well, that made people angry. And so even when interest came down on just fixed interest universal life, sometimes when people were minimum funding it to try to get the death benefit they wanted for the least premium, which isn't what it was designed for in the first place, but you can do that on that end of the spectrum, they were bugged when they had to start paying more money into it, maybe as much as a whole life policy for a few years. And they would go, well, that's why I bought this universal life, because it was cheaper than whole life for the same death benefit. Well, it means that if you were minimum funding it and the interest rate started to come down, you may have to put in a little bit more money. And people like predictability, right? The problem is with variable universal life, you are subject to market volatility. So if you're not maximum funding it, you're having to throw more money in to avoid it lapsing, because you've got to cover the cost of insurance. But it also means this. You may be clicking along and make some pretty good money for a few years, and in one single year like 2008, you could lose 40%. $1 million of cash value could go down to $600,000 in less than 12 months. And that's what people experienced in 2008 that had variable products. I've never owned a variable product, a variable annuity, a variable universal life. I never will, because I don't want that volatility. When indexing came out in 1997, I thought, now this is the way I want to go. Because you're going to learn you don't lose when the market goes down, because your money is not out in the market. You're linking your return to whatever the S&P or the Dow Jones does, but your money is not actually in the market. So when the market crashes, you don't lose. Your million stays safe, worth $1 million. You may not earn anything that year, but you don't lose. And as Will Rogers once said, people get more concerned about the return of their money instead of the return on their money when things get bad. And so that's why index universal life is so phenomenal. But let's go back and summarize the difference again between fixed and variable. Fixed universal life, you're just content with the general account portfolio rate of the insurance company. Now, back in the 1980 to 1990 era, I was happy with that because I never earned less than 11, and I was netting at least 10. But when interest rates started coming down, insurance companies got more creative, and that's why they came out with the idea of variable universal life. But then when the markets would crash, people would get upset. There was the unpredictability. People had to cough up more premiums that they weren't planning on. So I just was patient because interest rates were still good, and I averaged 8.2% clear up until 1997 when indexed universal life came out. And from 1997 on, I went from 8.2% up to 10.07%. I increased by about 2 percentage points my rate of return by linking to an index, which is not putting my money out into a variable environment. It's keeping it safe in the insurance company, earning the general account portfolio rate, but I'm linking the return, telling the insurance company, don't risk my principal. My million, if I have $1 million there, has to stay safe, earning 5 or 6 or whatever the general account portfolio rate is. I'm willing to give up the interest that you're trying to accumulate to pay me on the million. Let's say it's 6%. I'm willing to give up that 6% on my million, the 60,000, for you to do whatever you want to do with that 60,000, to have the wherewithal to pay me whatever the S&P does if it goes up. But if it goes down, I'm willing to relinquish the for sure 6%, because I know on the average I'm going to come out 2 percentage points higher by linking to an index without risking my principal that I had at the beginning of each year. So you're about to learn in the next few episodes this incredible concept of indexing. Most advisors think we talk about index mutual funds. No. Indexing is a strategy. I've often used the metaphor, if you're going to be playing in a golf tournament and you had the choice of using a professional golfer's clubs, or you could use like Phil Mickelson's swing, what would you choose? I'd rather have his swing, not the clubs. See, most advisors think it's in the clubs and, oh, well, here's the product, here's the universal life. No, it's in the swing. It's the strategy behind how you structure the universal life correctly, fund it properly under TEFRA, DEFRA, and TAMRA guidelines. And then also the strategy of indexing. Indexing is a strategy. It's a swing strategy. It's not the club. And so many advisors don't understand this. So this is crucial. You want to use indexed universal life to get rid of the market volatility, because variable products, they're subject to losses. And frankly, my clients, especially as they approach retirement or after retirement, do not want to have unpredictability. They don't want to have this volatility. They want to have predictable rates of return. That is accomplished much better with indexed universal life, or frankly, just fixed universal life. But because I know what has happened historically, I can usually earn at least 2% higher rates of return on the average using indexed universal life than fixed universal life. And actually, I can do far better than variable universal life. Sometimes advisors say, why would you cap yourself in an indexed universal life at 12% or 16% when the market did 20? Because I don't lose when the market loses 40. I don't lose a dime. And on the average, I'll come out way ahead with indexed UL compared to variable UL. So let's just connect the dots here by saying that the purpose of universal life in the first place, when E.F. Hutton came up with the idea, was what? For living benefits. So if I want my money to accumulate tax-free, be able to access it tax-free, and when I die, it blossoms and transfers tax-free, I want it to pass what I call the laser test. Now, LASER is an acronym that stands for Liquid Asset Safely Earning Returns. Now, the key elements of a prudent investment are these. Number one, liquidity. The ability to access your money when you need it, maybe with an electronic funds transfer or phone call. Safety, and I'm not talking about just safety of the institution, but safety of principal. Whatever I set aside, I don't want to lose the money I put in there due to market volatility. And here's my definition. Any year I make money, I want that to become newly protected principal. I don't want to ever lose in the future years money I made in previous years. Most advisors, most asset managers in variable products don't know how to do that. Number three, you want to earn predictable rates of return. You don't need pie in the sky rates of return. Rates of return tax-free of 7 to 10%, that's awesome. So liquidity, safety, rate of return, this sort of spells the acronym LSRR, laser. And then tax benefits are like icing on the cake. I'll take those. Now, I like to have my cake and eat it too. So I like to have all of the above. So you're going to learn here next that a properly structured, maximum funded indexed universal life insurance policy is my favorite vehicle by far over just fixed products or the volatile variable products, because I want to pass the laser test, and I'm going to show you a system to do that in future episodes. But the three greatest strengths is liquidity, the ability to access your money when you need it in an emergency. Number two would be safety of principal, preserve your principal and protect it from loss. And then number three is to earn predictable rates of return, a competitive rate of return that historically has beaten inflation. And of course, I want it to be tax-free. You can't be rowing upstream, so to speak, in a bank account earning 1 or 2%, 1 or 2 miles an hour on your money and have the current of inflation coming down at 5, 6, or 7. You're going backwards. So you're going to learn how to link your returns to the things that inflate by using indexed universal life. And by understanding the difference between fixed, variable, and then indexed UL, and you teach this to your client, it will be a no-brainer. They're going to thank you for looking out for their best interest. And so you're seeking the best return, but also at the lowest risk. Generally, when people look for high returns, they incur higher risk. No, I want to have very competitive rates of return tax-free and lower the risk. So you're going to learn how to do this.